What happens to your money when central banks go digital? Asterisk, the global financial system is approaching one of the most significant changes in modern history. Yet most people are barely aware it is happening. Around the world, central banks are developing and testing central bank digital currencies, often called CBDCs. These are not cryptocurrencies, not private stablecoins, and not payment apps. They are a direct evolution of state-issued money itself. At first glance, digital central bank money sounds harmless. After all, money is already digital for most people. Salaries are deposited electronically, bills are paid online, transfers happen instantly. So what really changes when central banks go digital? The answer is simple and unsettling. The control layer moves closer to you. A CBDC is digital money issued directly by a central bank, not by a commercial bank. Today, your money exists mostly as a liability of a private bank. With CBDCs, money could exist as a direct claim on the central bank itself. That changes the architecture of the financial system. One of the most important differences is programmability. Traditional cash is passive. It does not care how, when, or where it is used. Digital central bank money can be programmed. It can be designed to expire, to be spent only on approved categories, or to activate only under certain economic conditions. Supporters argue this is efficient. Governments could distribute stimulus instantly. Relief funds could be targeted. Fraud could be reduced. Tax collection could become simpler, but efficiency always comes with trade-offs. When money is programmable, it becomes a policy tool at the individual level. Instead of influencing behavior indirectly through interest rates, central banks could influence behavior directly through the design of money itself. That is a historic shift. Another major change involves access. In a CBDC system, individuals may be allowed to hold accounts or wallets directly with a central bank. This reduces dependence on commercial banks for basic money storage. During financial crises, this could prevent bank runs, because people could move funds instantly to the safest institution available. However, this also weakens the traditional banking model. Commercial banks rely on deposits to fund lending. If deposits migrate to central banks, lending capacity could shrink unless new systems are created to replace it. This is not theory. It is already being debated by policymakers. Privacy is another concern. Cash transactions are anonymous by design. Digital transactions are not. Even if privacy protections are promised, digital money creates records. Records create oversight. Oversight creates power. Once money becomes fully digital at the source, opting out becomes difficult. You cannot hold digital cash under a mattress. You cannot step outside the system. Participation becomes mandatory by default. This raises fundamental questions. Who controls the rules? Who decides how money functions? And what happens when financial policy changes overnight? CBDCs also shift how people think about trust. For decades, trust has been distributed across banks, markets, and institutions. A digital central bank system centralizes that trust. If it works well, stability improves. If it fails, consequences are systemic. The key point is not that CBDCs are good or bad. The key point is that they represent a structural redesign of money itself. And structural redesigns always produce winners and losers. Understanding this shift is no longer optional. It is becoming a requirement for anyone who cares about their financial future. How digital central bank money changes savings, banking, and wealth. When money changes, savings change first. In today's system, holding cash is a form of neutrality. It earns little, but it does not impose conditions. It allows flexibility. In a world of digital central bank money, neutrality may disappear. One of the most discussed implications of CBDCs is the ability to implement negative interest rates directly. Today, negative rates are difficult to enforce because people can withdraw cash with digital money only. That escape valve disappears. This means saving money could carry a direct cost. Central banks could encourage spending not by suggestion, but by design. Money could slowly lose value if held too long. From a policy perspective, this is powerful. From a personal finance perspective, it is disruptive. Traditional savings strategies may need to be rethought. Commercial banks also face transformation. If individuals can hold money directly with central banks, deposits may flow out of private banks during uncertainty. This could stabilize crises, but it could also reduce credit availability in normal times. Lending may become more centralized or more regulated. Mortgage rates, business loans, and consumer credit could be influenced more directly by policy decisions rather than market competition. For individuals planning long-term wealth, this matters deeply. Questions like how much cash should I hold? Should I pay off my mortgage or invest? How do I hedge against inflation? These questions take on new meaning when money itself becomes adjustable. Investments may become more attractive relative to cash. Real assets, equities, commodities, and productive assets could benefit from a system where holding money carries increasing friction, but investment risk does not disappear. It shifts. In a digital currency system, capital controls become easier to enforce. Movement of money across borders can be monitored and restricted in real time. This affects diversification strategies and global investing. At the same time, CBDCs could reduce transaction costs and improve efficiency. Payments could settle instantly. Cross-border transfers could become cheaper. This may benefit businesses and consumers alike. The challenge is balance. Efficiency without flexibility becomes rigidity. Control without accountability becomes risk. From a wealth-building perspective, CBDCs force individuals to become more intentional. Passive financial behavior becomes expensive. Active planning becomes essential. This aligns with a broader trend already underway. Inflation has already taught people that doing nothing with money has consequences. Digital central bank money accelerates that lesson. Those who understand asset allocation, risk management, and long-term planning will adapt. Those who rely on old assumptions may struggle. Money will still exist. Wealth will still be built. But the rules will be different. The hidden consequences most people are not discussing. The most important effects of digital central bank money are not technical. They are behavioral. When money becomes programmable, it becomes persuasive. Spending incentives can be adjusted. Savings behavior can be nudged. Economic activity can be shaped with precision. This level of influence has never existed at the individual level before. Supporters see this as progress. Critics see it as surveillance. The truth lies in governance. Privacy is often discussed but rarely defined. Even anonymized systems can be re-identified under pressure. Emergency measures tend to expand authority, not reduce it. History supports this pattern. There are also geopolitical consequences. Countries that control digital settlement infrastructure gain leverage over trade, sanctions, and financial flows. This could fragment global finance into competing systems. For individuals, this means financial freedom becomes more dependent on jurisdiction. Where you live may determine how flexible your money is. Another under-discussed issue is resilience. Cash works without electricity, digital systems do not. Cybersecurity becomes monetary security. System failures become financial emergencies. At the same time, CBDCs could reduce corruption, improve transparency, and lower costs. They are not inherently harmful. They are powerful. And power amplifies intent. The real risk is not digital money itself. The real risk is ignorance. People who do not understand how money works cannot defend themselves when the rules change. Those who understand systems, incentives, and long-term planning will adapt. This transition will not happen overnight. It will be gradual. Pilots will expand. Use cases will grow. Resistance will fade. By the time it feels normal, the structure will already be in place. The future of money will reward awareness, flexibility, and strategic thinking. It will punish complacency. Digital money is coming. The question is not whether you like it. The question is whether you understand it.